Good morning. For Fin4801, today we are going to be looking at study unit 3, which looks at chapter 3 of the textbook. And chapter 3 of the textbook looks at the relationship between risk and return. And in this case, we are going to be concentrating on the risk and return relationship for a single security. So you will see that chapter 3 looks at risk and return, and chapter 4 looks at portfolio management. So it means chapter 3, we first start off by looking at the risk and return relationship of a single security. So we are going to be concentrating more on the risk and return relationship for a single security. And then chapter 4, we now look at managing risk and return relationship for what? A portfolio of securities as well. So what this means is that chapter 3 and 4, they are very much related. So it's more like chapter 3 is now, chapter 4 goes on a bit level, higher level up compared to chapter 4 when it comes to the analysis. And please take note as well. Remember I said from chapter 1 to chapter 8 of the textbook, we are reviewing things that you should have done when you're doing your undergrad. So which means the things that are relevant to you when you look at the textbook is the things that you should have done when you did, if you're doing studying with UNISA, it's things that you should have done when you're doing Fin 2601 and when you're doing Fin 3701. Then you Fin 3702 material, we'll also look at it later on when we look at other chapters as well. But the main idea here is that you need to be reviewing or looking at things that you've done in Fin 3701 and Fin 2601. So because of that, you will see that some concepts we are not really going to spend time on them because you didn't cover them when you're doing your undergrad. But some concepts I'm going to make sure that I highlight to say, do this. And those concepts that I feel like, you know what, you really didn't do them when you're doing your undergrad, we're going to leave them out completely because there are some concepts which are covered in the textbook for your undergrad, the thick green and white textbook. You will see that there are some chapters or sections there that you left out in that textbook when you're doing your undergrad. Remember, the same textbook for Fin 2601, Fin 3701, and Fin 3702 is the same text, is basically the same textbook. So you will see that when you're covering those sections or chapters, there are some material or some part of the curriculum or part of the material in the textbook which was not necessarily deemed relevant for the curriculum. So you will see that even now, when we're doing chapters 1 to 8 as well, there are some sections or some concepts that we're going to leave out, mainly because you would not have covered them in undergrad. So which means that I don't see them being relevant. Even if you look at past papers and past assignments as well, it's not concepts that the lecturer would have asked, mainly because the main idea is that you are reviewing things that you'd have done not when you're doing your undergrad. So looking at the risk and return relationship, so looking at the chapter on risk and return, under introduction, they say financial management is about making investment and financing decisions. So such decisions involve risk. So what is risk? How do we determine required returns? So is it understandable that an investment's risk will affect the required return? So the higher the risk, the higher the required return. So what kinds of risks do companies face? So when company builds a new manufacturing plant, there is the risk that the product will not sell sufficient units for the companies to break even. Further, the company may not be able to achieve the expected price due to unexpected competitive pricing decisions. So a high level of operating leverage may mean that a company's earnings are significantly affected by a small change in sales. So a mining company such as Goldfields may find that the initial capital cost and the ongoing cost of operating a gold mine may be significantly higher than expected at the time of the investment. So a company borrowing funds may be subject to interest rate hikes, which may result in reduced cash flows. So yet companies may experience substantial improvements in operating returns due to unexpected price increases as well. So which means in this case, if you check on the next paragraph, they say, few questions about future events can be answered with certainty because we don't know whether these decisions are good or bad until future events either confirm or repudiate the expectations on which the decisions were based. So money is invested by financial managers in assets which it is focused will generate income and increase the value of the firm. So similarly, investors make investment decisions based on their expectations, and only in the future will it be possible to determine whether these investments were profitable. Evidently, not every investment decision would be profitable because no one can consistently make accurate predictions about the future. So making predictions is clearly hazardous because you will sometimes be wrong. So methods must be sought to keep the margin of error as low as possible. So information about the past must rank as a significant input into predictions about the future. And however, if it is known that the past is likely to be replicated in the future, information about the past events is of little value and must be replaced with realistic estimates of future expectations. So this chapter suggests methods by which expected returns can be measured. It discusses the uncertainty that surrounds the expected returns, that is the risk that the returns may not be achieved, and measures this risk. So this requires an application of certain basic statistical techniques. And on the next paragraph, they say, once we determine how to measure an investment's expected return and its associated risk, we compare investments with different risk and return profiles. So we thereby lay the foundation for the study of portfolio theory in chapter 4. That's why I was saying chapter 3 and chapter 4, they are very much interrelated, because we start off by analyzing the risk and return relationship of a single security. Then we now go on to analyze the risk and relationship of what risk and return relationship of what of a portfolio of securities as well. So if you skip the next paragraph, they say investment risk can be measured by comparing the risk of one investment with that of the market as a whole. So the risk comparison is denoted by a firm's beta, which measures the relative volatility of a share to the market. So if a firm's beta is 1.2, then this means that the firm's shares are more volatile than the market. So if the market goes up by 55%, then we would expect the share price of the firm to go up by 5 multiplied by 1.2, which is 6%. So please take note. When you look at the relationship between the beta of the market and the beta of the security, the beta of the market is always assumed to be 1. So please take note of this. The beta of the market is always assumed to be equal to 1. So here they say, the market is assigned a beta of a score of 1, and every share there is a score that can be measured against this norm. So we write about this measure of risk not in chapter 4. So please take note, the beta of the market is always going to be assumed to be 1. So we're basically saying, when you're measuring beta, you're looking at the risk and return relationship. You are basically looking at the return relationship between the market and the security. So when you're looking at the beta of the market, you are looking at the relationship between the return in the market against the return of the security. So basically, beta looks at the gradient of the change in returns in the market over the change in return of the security. So remember, when you're doing your high school, we said the gradient of the curve shows you the relationship between the change in y over change in x. So in this case, y would be the market. So y would be the market and x would be the asset. So beta basically looks at the change in the relationship between the change in the return of the market to the change in the return of the asset. Are we on the same page? Are we together so far? So based on this, they say, when you're now looking at the concept of risk. So before we go there, so it basically means when a security has a beta of 1.2, right? So it basically means that it's beta, or it's 1.2:1, which basically means that when a security has a beta of 1.2, it basically means that the beta is basically 1.2:1, which means that if the security changes, if the security beta is 1.2, it basically means that the change in the return of the security compared to the change in the what is happening in the market. Remember, we said the beta of the market is always going to be equals to 1, which means that if a security has a beta of 1.2, it basically means that it's 1.2:1, which means the change in the rate of the security is for a 1 unit change in the market return, the change in the security return is going to be 1.2. So that's basically what the beta is going to be interpreted as. So based on this, if we now look at section 1, which looks at the concept of risk, before we go on to section 1, are there any questions so far? So when you look at the concept of risk, they say the word risk is usually used in the context of a potential hazard or the possibility of loss resulting from a given action. So in financial management, the term indicates that there is an expectation that the actual outcome of a project may differ from the expected outcome. So the magnitude of the possible difference reflects a magnitude of risk. So risk may also be positive if you may receive more than what you expect from your investment. So the terms risk and uncertainty are often used interchangeably. There is, however, a formal difference between the two terms. Uncertainty implies either that all the alternative possible outcomes cannot be identified, or that no probability can be attached to an alternative possible outcome. And risk implies that it is possible to attach probabilities to identify the expected outcome. So what does that mean? Risk is a subset of uncertainty. Risk is a subset of uncertainty. So which means risk is basically an element of uncertainty. So which means when you're now looking at the concept of risk and uncertainty, we're basically saying uncertainty covers an infinite world of things that can possibly happen. And if they are infinite, mainly because there are so many different things that can happen, and sometimes it's not possible to measure them. So because they are infinite, because it's not possible to measure them, it basically means that you are not able to allocate probability to a situation of what? Uncertainty. But now, in simple terms, we can now say risk within this world of uncertainties. Risk is those relevant factors that affect what? Uncertainty. So those those factors that are now going to be deeming relevant to you that affect uncertainty is basically what we're going to be indicating as risk. So which means risk is a subset of uncertainty. So uncertainty is this infinite world of possible things that can happen. Risk is now those possible things that can happen that are what? Relevant to you. So because you're now looking at these possible risk of things that can happen that are relevant to you, that's why we say that uncertainty, because there's an element of infinity element, because there's an infinity factors that can affect your investment, it basically means that you cannot not allocate probabilities. But when it comes to an element of risk, you are able to allocate what? Probabilities. So which means when we are now looking at this universe of uncertainties, it basically means that when you're assessing your investment, what is relevant to you is this element of risk, not necessarily uncertainty. Although, when you are going to go further in this chapter, whenever they are interchanging uncertainty and risk, just know that they are basically referring to risk. Although, so even though there's a difference, whenever they mention uncertainty, just know that they're going back to the element of what? Of risk as well, because they are interchangeably using them, although to be very strict, they are two different terms. But for the sake of analysis, we can use them interchangeably. They are basically going to be used interchangeably. So that's why you see that in this case, they say we can if you look at later on in the chapter section or later on in this section, they're basically saying that they are going to be, they can be used interchangeably, although in a strict sense, there is a difference between risk and uncertainty. So are we on the same page when it comes to the issue of risk and uncertainty? So under this section, they say, so this strict distinction between the two terms is, however, not necessary for our purposes. So for our purposes, when we're analyzing, we are going to assume that risk and uncertainty are one and the same thing, although in the strictest form, they're not necessarily what? The same thing. Moving on, they say from the viewpoint of an investor, investment opportunity can be broadly classified into two categories. Investment opportunity with certain outcomes, where there's no expectation that the actual outcome will differ from the expected outcome. And those investment opportunities with uncertain outcomes, where there's some probability that the actual outcome will differ from the expected outcome. So these are the two types of what investment opportunities that we are going to be looking at when it comes to investments. Now, after this, they also say, turning specifically to investments in the shares of listed companies, there are two major areas of risk which will be considered by potential shareholders: business risk and financial risk. So we need to be able to know exactly what business risk is and what financial risk is, because they can potentially ask you as a short question in question number 1 of the exam. So here, when they talk about business risk, they say business risk results from the nature of the business itself. It includes all the uncertainty that surrounds the industry in which the business operates. So this is reflected in the variability of sales and the structure of costs. So the variability of sales results from factors such as the likelihood of increased competition, the availability of substitute products, the effect of recession, and rapid changes in technology and market shifts are also factors that may lead to increased business risk. So the structure of cost depends on the relationship between the fixed and variable, as shown in example 3.1. So before we look at example 3.1, in short, when we're looking at business risk, remember we said we're looking at the variability of our sales of our income, which is our sales revenue, and our expenses. So what does that mean? Business risk is reflected in the statement of comprehensive income when you're now looking at your sales revenue and your operating expenses. So the business risk element is reflected in your statement of comprehensive income when you're looking at the relationship between your revenue or your income compared to your operating expenses. So the more uncertainty you have regarding your income, the higher the business risk. And the more uncertainty you have regarding what? Your fixed income, your expenses, the higher the what? The business risk. And also, the higher your fixed expenses, the higher the business risk. And in this case, when you're now looking at the relationship between your fixed costs and your variable costs, when you're now analyzing business risk, we now look at the concept which looks at what? Cost volume profit analysis. So to understand this better, they give us that example 3.1. Can you quickly read through that example and we go through together? So they give us the following information. They give us the fixed cost of the company. They give us the variable cost per unit, the selling price per unit, and then they give us the expected demand of those goods. And based on this, they tell us that when it comes to your sales revenue is dependent on exactly how many units you sell. The higher the number of units you sell, the higher the sales revenue you generate. Your fixed costs remain the same irregardless of how many units you sell. So no matter how many units you sell, your fixed costs are expected to remain the same. Then your variable costs are expected to increase depending on exactly how many units you sell. So your variable costs are expected to increase depending on exactly how many units you sell. Now, based on this, now we need to find out exactly, so what is the relationship between your income and your expenses, so that we're able to estimate to see exactly, so when are you expecting to start making a profit given your expenses? So what do we see? If you check on our information that is given, they tell us that your fixed costs are 10 million per year, right? So if your fixed costs are 10 million per year, it basically means that your expenses or your costs or your total costs, the graph of your total cost starts increasing here, because your total cost takes into account your fixed cost and your variable cost. So which means this shows us the fixed cost, which remains the same. Then your variable cost starts increasing depending on exactly how many units you sell. And at the same time, your revenue, your sales revenue, increases from zero depending on exactly how many units you sell. So the question would be, so when are you going to break even? So you break even when you neither make a profit or a loss. So you break even when you neither make a profit or loss. So we need to find out exactly, so how many units must you sell for you to neither make a profit or loss? So how many units must you sell for you to cover your total cost, which is your fixed cost and your variable cost? So this will tell us, so this is what we refer to as the break-even point. So as a formula, your break-even point is given as your total cost divided by your selling price per unit minus your variable cost. It's your fixed cost divided by your selling price per unit minus your variable cost per unit. So this will tell us exactly what the break-even point would be. So from the given information, we are told that the fixed costs are 10 million. Our selling price per unit is equal to, our selling price per unit is equal to 1,000, and our variable cost per unit is equal to 400. So how many units do we need to sell for us to be able to break even? How many units do we need to sell? How many units do you need to sell? So for us to break even, how many units do we need to sell?
16,667 units.
667. So for us to break even, we need to sell 16,667. Also, out of interest, so how much sales revenue do we need to generate for us to break even? So our sales revenue that we need to generate for us to break even is going to be, we are selling at 1,000 rand per unit, and we're selling 16,667. So how much sales revenue do we need to generate for us to break even? How much in sales revenue?
Uh, 16,667,000.
So graphically, if you look at it graphically, if you check on our graph, graphically, it would mean we're saying this is our break-even point. So the estimated number of units we need to sell in this case for us to break even is 16,667, which is between 15,000 and 20,000. And at the same time, the total sales revenue that we need to generate in this case is about 16,667,000, which is also between 15 million and 20 million. So this is basically our break-even point. So this is the point we neither make a profit or a loss. And in this case, we're talking about what? Operating profit or operating loss. Are we on the same page? Any questions so far? So that's what they are alluding here when they say our break-even point in units is going to be 16,667. So here they say once the break-even number of units has been sold, each additional unit sold adds to contribution to what? Add its contribution to profit. So table 3.1 indicates the effect of earnings before interest and tax of different what? Sales volumes as well. So which means in this case, if we're going to be selling 30,000 units, our earnings before interest and tax is going to be 8 million. If we're going to be selling 40,000 units, our earnings before interest and tax is going to be 14 million. Are we on the same page so far? So here they say, please take note. There's a very interesting question that they also brought in the assignment as well, where, yes, we have seen that for us to break even, this is how much we need to sell, how many units we need to sell, and how much sales revenue we need to generate as well. Then they can also give you a concept where they give you the target profit to say, if you want to generate a certain amount of money as a profit, then how many units do you need to sell, right? So if you want to generate a certain amount of as a profit, then how many units do you need to sell? So let's say, for example, our target profit is equal to 1 million. Our target profit is equal to 1 million. So we need to find out exactly, so how many units do we need to sell for us to be able to achieve this target profit of what? of 1 million. So to find out exactly how many units you need to sell, you're going to say the target number of units is going to be equal to your fixed cost plus your target profit divided by your selling price per unit minus variable cost per unit. So in this case, it would be equal to our fixed costs are 10 million. Our target profit is 1 million. Our selling price per unit is 1,000 minus 400. So for us to be able to achieve this target profit, how many units do we need to sell? How much do you get? How many units do you need to sell? How many units do we need to sell?
18,334 units.
330, is it 34 or 33 units?
It says 33,33.
Yeah, which remember you cannot round it off to the nearest one because remember it's from 0.33. The 3 here is less than 5, so you round it off to the nearest 0, isn't it? To prove this, we're going to say our sales revenue is equal to 1,000 multiplied by 18,333. Our variable costs are equal to 400 multiplied by 18,333. Our fixed cost is equal to 10 million. So given this, our earnings before interest and tax, which is our target profit, will be equal to how much? So 1,000 times 18,333, how much do you get? How much do you get?
18,333,000.
18,333,000. And 400 times 18,333, how much do you get?
7,333,200.
7,333,200. Remember, we are saying less variable cost, less fixed cost. So how much is our earnings before interest and tax in this case? How much do we get?
It's 999,800. 999,800.
So you get 999,800, which is off the mark by a couple of hundred because of the rounding off effect here, which is close to the million, the target profit. So it's very close to the target profit of 1 million because it was off the mark because of the effects of what? The rounding off there. Are we on the same page? Any questions? Anyone lost? So we can move on. So on the next section, they say, it can be seen that while sales increased by 33.33% in the example that they give us here, because your sales was 30 million, now it's 40 million. So it is increased by 33.30% from 30 million to 40,000 units. The earnings before interest and tax increased by 75% from the 8 million to 14 million. So this results from the leverage effect of fixed costs. So the degree of operating leverage obtained at 30,000 units can be expressed as follows, where we say your degree of operating leverage is given as your contribution over your earnings before interest and tax. And your contribution is given as your total sales revenue minus your total variable cost divided by your total sales revenue minus your total variable cost minus your fixed cost. So this will give us the degree of operating leverage at the base level. And in this case, is the base level of units. So to put it differently, we are saying your degree of operating leverage, if you still remember from undergrad, where you analyze operating leverage, we say your degree of operating leverage is given as your quantity multiplied by your selling price per unit minus your variable cost per unit divided by your quantity multiplied by your selling price per unit minus variable cost per unit minus fixed cost. So that's basically, that's the formula that we used when we're doing undergrad. Now, if you expand this formula, this means your quantity times selling price per unit gives you your total sales. Your quantity times variable cost per unit, because you're expanding this bracket. So your quantity times variable cost per unit gives you your total variable cost divided by quantity times selling price per unit, your total sales. Quantity times variable cost per unit gives you your total variable cost minus your fixed cost. And we know that your selling price, your sales minus variable cost gives you your contribution. So your contribution is basically your sales minus variable cost divided by your sales minus variable cost minus fixed cost gives us the earnings before interest and tax. So these are the different ways that you can calculate the degree of operating level at the base level of units. Are we together? So how, whether you are going to be using this formula or using this formula or using that formula, it will depend on exactly what information they give you on the question. And remember, if it's going to come out in the exam, expect it to be coming out as one of those short questions. Are we together? All right. In analyzing our break-even point, there are also other factors that we need to also take into account as well in analyzing the break-even point. So there are other factors that we need to take into account. Remember we said in analyzing our break-even point, remember we said the break-even point is given as your total fixed costs minus selling price per unit as your total fixed cost divided by your selling price per unit minus variable cost per unit. So your break-even point is given as your total fixed costs divided by your selling price per unit minus variable cost per unit. So now we need to find out exactly. So how can we reduce the break-even point? So how do we reduce the break-even point? Reduction of the break-even point can be achieved by either reducing the fixed costs or increasing the selling price per unit or reducing the variable cost per unit. So that's one way that you can be able to reduce the break-even point. So as a potential theory question, they can ask you and say, how can we reduce the break-even point? For us to be able to reduce the break-even point, it's either we reduce our fixed costs, because if you reduce our fixed costs, it basically means that we're able to cover our fixed operating costs sooner, or increase the selling price, because if we increase the selling price, we're able to sell less units for us to be able to meet our fixed of our total costs. And if we reduce the variable cost per unit, it means that we need less, we're going to be able to sell less units to meet our total costs as well. So please make sure that you take this in mind, because they can potentially ask you this as a theory question. Are we on the same page? Any questions? Anyone lost? So as an example, to demonstrate this relationship, as an example, if you check on page 6 of the textbook, they tell us that they give us an example where they are reducing, they are basically having a situation where they are increasing, the fixed costs have increased to 15 million. The selling price per unit has gone down, but the variable cost per unit has gone down. And we are looking at the net effect or the overall effect as well. So the overall effect in this case is that the number of units that are going to be break-even point is basically going to end up increasing from 16,667 units to 20,000 units. So it will depend on exactly. So when you're looking at the overall effect, you need to check to see exactly what is the overall effect on fixed costs, what is the overall effect on selling price per unit, and what is the overall effect of variable cost per unit. But if you are going to say that one factor changes and other factors remain the same, to reduce your break-even point, it's either you reduce your fixed costs, you reduce your variable costs, or you increase the selling price per unit. When you're now looking at the net effect or the multiple effect on the changes in these variables, you now need to calculate to see exactly overall how is the change in this variable going to end up affecting our break-even point. But ideally, as an entity, you want your break-even point to be lower, because the lower your break-even point, the lower your business risk as well. So the lower your break-even point, the lower the business risk that you're exposed to. Are we on the same page? Moving on with the chapter, they give us that example where we look at the percentage change in sales revenue over the percentage change in earnings before interest and tax as well. And in this case, your degree of operating leverage in this case is equal to an amount of 3, where they say in this case, your degree of operating leverage at 30,000 units is given as 30 million, which is your sales revenue, minus your variable costs of 7.5 million, which is your variable cost, divided by your sales revenue minus variable cost minus fixed cost, which gives us 7.5 million. So in this case, your degree of operating leverage is given as 3. Are we on the same page? Are there any questions? Please note, another way you can deduce the degree of operating leverage is where you're going to see your degree of operating leverage can be given as your percentage change in earnings before interest and tax divided by the percentage change in sales units. If you look at the example that they give us there, if you check on this example, do you see that, remember they said here, they said your sales revenue, your sales in number of units is increased from, your sales in this case is increased from 30,000 units to 40,000 units. So it's a 33% increase in sales revenue. It's a 33% increase in sales revenue. Then our earnings before interest and tax is increased from 7.5 million to 15% to 15 million, which is a 100% increase. So which means in this case, 33%, 100% divided by 33%. How much do you get as your degree of operating leverage? It's about 3, isn't it? So whether you use this formula or you're going to be using it at the base level of units there, you should be able to get the same amount. Are we on the same page? Any questions? Anyone lost?
Sorry, Rhinus. I just have a problem on my calculator. When I press like the 100 and I press on the sharp calculator second function and percentage, it says error 1.
When you're entering the amounts 100% there, right? Just enter it as a value because it's also being divided by the value. Where, because remember they're having the same coefficient. They're having the same coefficient being a percentage there, isn't it? So if you're calculating the degree of operating leverage here, you're just going to say 100 divided by 33, because at the end of the day, the numerator, the denominator here comes with the numerator there. So it's no longer going to be valid. That's why you see that your degree of operating leverage is not necessarily a percentage. It's just a figure as is. Because the percentage at the denominator there comes with the percentage at the numerator. So the only thing that you have to do now is to find, say, 100 divided by 33, which will give you your degree of operating leverage. And remember, your degree of operating leverage is not a percentage. It's not in rent. It's not a rent amount. It's not a percentage amount. It's just a figure as is. Are we on the same page? Because the denominator comes with the numerator, which means the only thing that you have to do now is say this divided by that. Are we together?
Yes, thanks.
So your degree of operating leverage is the figure on its own. It's not a percentage, it's not a round amount. So even if you use it at base level, your contribution is a round amount, your earnings before interest and tax is a round amount. So which means the rent and the rent they are going to cancel out each other, which means your degree of operating leverage in this case is just going to be a value, not a percentage, not a rent amount. Are we together? Any questions? So can you move on? On the next section, we also look at, here they say, it is worth noting that managers do not have total control over the degree of operating leverage. Often, the nature of the industry prescribes the extent to which the business must incur fixed costs. So it's not all the time that the company is going to be in control of that, the degree of operating leverage. Next, we're going to look at financial risk. And here they say, financial risk on the first paragraph, they say, financial risk results from the practice of financing a part of the firm's assets with interest-bearing debt with a view of increasing the ultimate return to the ordinary shareholders. So interest must be paid regardless of the performance of the firm. So as a result, a firm which is liable for fixed interest payments is exposed to a risk of default, which is not faced by a firm financed exclusively with shareholders' funds. So in this case, they say, when the firm is experiencing boom sales, the return on assets is likely to be considerably higher than the cost of debt. So as a result, positive financial leverage is experienced which enhances the return on equity. And however, in recessionary times, the opposite effect is experienced, resulting in a possibility of defaulting on creditors. So the company without debt is not subject to this risk, as all losses are fully absorbed by the shareholders. So the degree of operating leverage, the degree of financial leverage arises only after the earnings before interest and tax has been calculated. So it is identical to concept of in concept to the degree of operating leverage, as it increases fixed costs, being the fixed cost of interest which must be paid. So the formula for determining the degree of financial leverage is as follows, where your degree of financial leverage is given as your earnings before interest and tax divided by your earnings before interest and tax minus total interest expense. So your degree of financial leverage, is given as your quantity multiplied by selling price per unit minus your variable cost per unit minus fixed cost divided by your quantity selling price per unit minus variable cost per unit minus fixed cost minus interest expense. And this will give us the degree of financial leverage at base level of units. So your degree of financial leverage at base level of units can be given by this. So this means this can be further simplified into your sales minus variable cost minus fixed cost divided by your sales minus variable cost minus fixed cost minus interest expense. So this will give us the degree of financial leverage. Your sales minus variable costs minus fixed costs gives us the earnings before interest and tax. So it's the same as saying your earnings divided by your earnings before interest and tax minus your interest expense. So this will give us the degree of financial leverage. Are we on the same page? Any questions? Anyone lost? At undergrad, they also looked at the case of preference share dividends, but I don't want to go into that because with preference share dividends, it makes the because remember, if there's going to be preference share dividends, there's going to be another element that you take into account, which is the after-tax effect of what? So not the after-tax effect, the before-tax effect of what? Preference share dividends payments, which means that the preference share dividends are going to be multiplied by 1/1 minus tax rate. But for now, since it's not covered in the textbook, we're going to leave it out, the effect of preference share dividends. But know that when you're doing your undergrad, you also took them into account, although I'm not expecting the lecturer to be asking you regarding preference share dividends, because on the concept covered in the textbook, we are assuming that the company is not financed with what? Preference share dividends or preference shares. On the next section, they also look at looking at the total company risk, where they say the operating leverage and financial leverage work together to create what is referred to as the degree of combined leverage. So this results from the product of the degree of operating leverage and the degree of financial leverage, which may be expressed as follows. So the degree of combined leverage Okay, so the degree of combined leverage is given as your sales revenue minus variable cost divided by your sales revenue minus variable cost minus fixed cost minus interest expense. So this is the same as your contribution divided by your net income before taxation. Divided by your net income before taxation. And your degree of combined leverage is also given as your degree of operating leverage multiplied by your degree of financial leverage. So for your degree of combined leverage, we're saying degree of combined leverage. When you were doing your undergrad, you also referred to it as degree of total leverage. So when you're doing your undergrad, you also refer to it as degree of total leverage. You refer to it as the degree of total leverage because it took into account the effects of operating and operating. It also took into account the effect of operating leverage and financial leverage. Hence, the degree of total leverage can also be referred to as what? So if you see degree of total leverage or you see degree of combined leverage, you should know it's one and the same thing. And this is given as your quantity, your selling price per unit, minus variable cost per unit, divided by your quantity selling price per unit minus variable cost per unit minus your fixed costs minus your interest expense. So this will give us the degree of combined leverage. Now, if you expand this equation, your quantity times selling price per unit gives you a total sales. Quantity times variable cost per unit gives you the total variable costs, divided by quantity times selling price per unit gives you your sales variable costs minus fixed costs minus interest expense. So your sales minus variable costs gives you your contribution, divided by your sales minus variable costs minus fixed costs minus interest expense gives you your earnings before tax. So it's basically your earnings or your net income before tax. The degree of combined leverage can also be given as your degree of operating leverage multiplied by your degree of financial leverage. So your degree of combined leverage can also be given as your degree of operating leverage multiplied by the degree of financial leverage. So if you multiply them together, they give you the degree of combined leverage. So it will depend whether you're going to use this, or you're going to use this, or you're going to use this, or you're going to use that. It all depends on exactly what information they give you. Are we together? Any questions? Anyone lost? Please take note as well. Your degree of combined leverage, can also be given as, so your degree of combined leverage can also be given as your percentage change in earnings per share divided by your percentage change in sales units. Your degree of combined leverage can also be given as your percentage change in earnings per share divided by your percentage change in sales units. So this can also give you the degree of combined leverage. The degree of financial leverage can also be given as your percentage change in earnings per share divided by your percentage change in earnings before interest and tax. So your degree of financial leverage can also be given as your percentage change in earnings per share divided by your percentage change in earnings before interest and tax. So just know these as well, in case the lecturer tries to make things a little bit difficult and give you these different variations as well. You should know them because you covered them when you're doing your undergrad. You did cover this when you're doing your undergrad. So you should know these variations in case the lecturer tries to trick you in these short questions as well, and they give you these other variations of calculating your degree of operating leverage, your degree of financial leverage, or your degree of combined leverage as well. Are we on the same page? Any questions? Anyone lost? Are there any questions? Can we take a few minutes break until 12:30? So can we take a few minutes break until 12:30? Then at 12:30, we're going to look at calculation of risk and return for single assets. So can we take a few minutes break until 12:30? Then at 12:30, we're going to be looking at calculation of the risk and return for single assets. So can you take a few minutes break until 12:30? Then we look at the risk and return relationship for single assets. Can we continue? On the next section, which is section 2 of the chapter, before we go on to section 2 of the chapter, remember we're looking at the degree of company leverage, right? Or combined leverage. So here they say, the use of degree of combined leverage as a means of assessing risk is useful for the management of a company, particularly when budgets are being prepared or capital expenditure is being considered. So investors do not normally have access to this type of information. So however, investors do understand that the companies that operate in such sectors as the airline, oil and aluminium, chemical, shipping, steel, and manufacturing, and the hotel sectors will be subject to relatively high levels of operating leverage. So these are capital-intensive industries requiring significant investment in airplanes, property, ships, and plant and equipment. So high levels of operating leverage may be accentuated by high levels of financial leverage. So companies that operate in retail sectors such as Pick and Pay and Foschini may have low levels of operating leverage. So retailers will, however, often have fixed commitments in relation to long-term leases. So investors use mainly stock market indicators to assess the risk in those cases as well. So please just take note of this, although it's not something that I would say I would be expecting it to be asked as a theory question in the exam. So moving on to section 2 of the chapter, we're now looking at how do we determine the return for a security, for a particular security. So here they say, an investor is able to measure past returns from investment in a single share with relative ease. So the two components of return are the dividends received and the capital or price appreciation of the share, expressed as follows, where we say the return to the shareholder is given as the price at the end of period P minus the price at the beginning of period T plus the dividend during the period divided by the price at the end of the period. So this will determine exactly what the price, the return will be equal to. So here we're saying the return on a security, in this case, it's a share, is given as the price at the end of period 1 minus the price at the beginning of period plus the dividend during the period divided by the price at the beginning of the period. Then if you multiply this by 100, this will give us the return. So when you look at your timeline, we're basically saying this is period 0. So period 0 is here. So period 1 is when you're moving forward one period. Period period minus 1 is basically where you're moving forward, moving backwards one period. So which means in this case, we're saying at the end of the period 1, what is the price of the share? At the beginning of period 1, what is the price of the share? And during the course of the period there, how much is the dividends end over this period, which is usually what? The dividend at the end of that period as well. And divided that by what? By the price at the beginning. So this will give us the what? The return end on the investment during the course of the investment period. So are we on the same page or together when it comes to that formula for calculating the return? So the return on a security would be given as this. And in most cases, this is how we would be able to calculate the actual return on a particular investment. Please take note as well. The price at the beginning minus the price at the end gives us the price appreciation or depreciation, depending on whether the price went up or the price went down. So this will tell us exactly whether there was a price appreciation or depreciation during that particular period as well. When you're doing your undergrad, the dividends, they were referring to it as the cash flow during period T. So they were also referring to it as the cash flow during the period as well. But remember, to the shareholder, their cash flow would be the dividends. Moving on. When you look at measuring the expected return on a single share, when you look at measuring the expected return on a single share, they tell us that when you're measuring the expected return on a single share, the expected return is given as the sum of the returns multiplied by, so the expected return on a single share is given as the sum of the returns multiplied by the probability of earning those returns. So when you're assessing the risk or the return or the expected return of a single share, so when you're assessing a single security, the expected return on that single security is given as the sum of the return multiplied by the probability of that return. So it's the sum of the return multiplied by the probability of that return. In the example that they give us in the textbook, it's too long because I feel there's too much information that they give us there. Let's say you are given this information where we have security, and we have security A, B, and C, and the return or the expected return of these securities is equal to, for A, you're expecting to earn a return of, say, 15%. B, you're expecting to earn a return of 20%. And C, you're expecting to earn a return of 30%. And the probability of earning these returns, let's say there is a 10% probability of earning 15% return. There is a 50% probability of earning 20% return, and then there's a 40% probability of earning 30% return. So then they ask you to calculate the expected return. So given this information, if you're asked to calculate the expected return, you're going to say your expected return, note that in the textbook, the return they are referring to it as K. So if you use the notation of K or use the notation of R, it's basically one and the same thing. Let me see. Okay, here they're talking about, they're referring to the probabilities R. Okay. So your expected return is given as your return with a bar on top. So the return, if it's K, it's going to be K with a bar on top, is given as the sum of, for the first scenario, your return is 15%. The probability of the return is 10%. So as a decimal, it gives us how much? You're putting it as 0.1 plus. For the second scenario, your return is 20, and the probability of this return is 50%, so it's 0.5. The next scenario, your return is 30, and the probability of that return is what? 40%, which is 0.4. So given this information, how much do you get as your expected return of this security? Sorry, instead of saying A, B, and C, this is wrong. I would say we can put it as market conditions, economic conditions. So So we can put it as economic conditions, where we are saying if there's going to be an expansionary economic condition, we're expecting a return of 15% from our security. If there's going to be a normal economic condition, we're expecting 20% return. And if there's going to be, this would be, okay. This would be expansionary because this is the highest amount of return. And this would be a contractionary. So under normal circumstances, we're expecting our share to give us a return of 20%. So please do away with what I've given you before. Under normal circumstances, we are expecting our investment to give us a return of what? 20%. And the probability of us experiencing a normal condition in the economy is 50%. Then if the economy goes through an expansionary phase, we're expecting our investment to give us 30% return, and the probability for us to experience an expansionary phase is 40%. If the economy goes through a contractionary phase, we're expecting our investment to give us a 50% return, and the probability of us experiencing a contractionary phase is basically 10%. So given this information, now we need to find out exactly for this single security, what is the expected return of this single security? So given this information, how much would you get as the expected return? How much is our expected return?
23.5 or 24.
So our expected return will be 23.5%. So our expected return would be 23.5%. Remember, it's a single security. Previously, I had made a mistake there because I was saying securities A, B, and C. It's a single security, which means what is going to be affected is the return of this single security is the economic conditions. Whether the economy goes through an expansionary phase, the normal phase, or the contraction phase. And these are the returns that we're expecting to generate, and these are the probability of us generating those returns as well. So a similar example, although I don't want to use the example in the textbook, because when calculating the risk now it becomes too tedious to do the calculation, you will see that they giving us the state of the economy being a super boom, a normal, a recession, or a severe recession. And these are the probabilities and the returns that we're expecting to generate. And this gives us the expected return. And it's based on this particular formula. So are there any questions when it comes to calculation of the expected returns? Next, we now need to find out exactly, so how do we find, now we have the expected return, how do we determine the expected or corresponding risk? Because remember we said for every return, there's also going to be a corresponding what level of risk that you're going to be taking into account as well. So in measuring the corresponding risk, we are going to be determining the standard deviation. So for the single security, in measuring the corresponding risk, we're going to be determining the standard deviation. And your standard deviation which is given as the level of volatility is given as, to get the standard deviation, okay, to get the standard deviation, step number 1, you need to calculate the expected return to get the standard deviation. Step number 2, you need to calculate the variance. So to calculate the standard deviation, step number 1, always calculate the expected return. Then step number 2, you need to calculate the variance, and the variance is given as the sum of the return minus expected return. Remember, the expected return is what we say is this arrow with the bar on top. So it will be the return observed minus the expected return that we have calculated in step number 1. And you're going to multiply this by the probability of earning these returns as well. So which means in this case, your variance would be given as, for the first scenario, your return was 15%, your expected return is 23.5%, and the probability of this happening is what? 10%. So which means in this case, we're going to say is 15 minus 23.5. You square that, multiply by the probability of this happening, which is 10%. You are going to put it as a decimal plus, because you're summing up the different scenarios. The second scenario, your return is 20 minus 23.5 squared. Sorry, this is going to be the return minus expected return. You're going to square this, then you multiply that by what? By the probability. Hence, we're putting to the power of 2. Then the probability for the second scenario is 0.5. Plus, for the next scenario, your return is 30%. Your expected return is 23.5. Square that, and the probability of this happening is 40%, which is 0.4. So given this information, now we need to find out exactly, so what is the variance? Then after you calculate the variance, that's when you can now calculate what? The standard deviation. So for you to calculate the standard deviation, you cannot calculate the standard deviation without calculating the variance. So in this case, how much do you get as the variance? Are we getting the same amounts?
Ranus, will it still be acceptable if I get 30.26%?
Yeah, it's to be a difference of rounding off, depending on how you do the calculation. So it should be acceptable.
Okay, thanks.
So my advice would be, when you're doing your in-between calculations, try as much as possible to round off your calculations to at least 4 decimal places. So try as much as possible to round off your calculations to at least 4 decimal places. It makes it what? The more the decimal places you have, the more accurate your answer would be. So ideally, when you're doing your in-between calculations here, try as much as possible to round off to at least what? 4 decimal places. Now that we have the variance, are we on the same page when it comes to calculation of the variance? Are there any questions? Any questions? Now that we have the variance, our next measure of risk would be the standard deviation. And the standard deviation is the square root of the variance. So your standard deviation is the square root of the variance, which means in this case is going to be equal to the square root of 30.25. So in this case, how much would you get as your standard deviation? Yeah. Need to change this. Please note, if you check on the information that they give us, there's something that is going to be a little bit of a variation on how you calculate the standard deviation compared to what you were doing when you're doing your undergrad as well. So to demonstrate this, I'm going to explain it using the example in the textbook. I'm just going to quickly show you using the example in the textbook. When you're calculating your variance, your returns, you're going to put them as decimals. So when you're calculating your variance, your returns, you're going to put them as decimals, because if you put them as full percentages there, for some reason, I'm not sure exactly why, the answers that you're going to be getting is going to be a little bit different from the answer that they are expecting you to get in the textbook as well. So when you're calculating your variance, the answer you should get in the the returns that you're going to be calculating there, you need to put them as decimals, not what as percentages, because the answer is going to be a little bit different. Let me demonstrate this to you using the example that is given in the textbook, because this is where your calculation of standard deviation in the text, when you're doing your undergrad, your calculation method is basically different from how you calculate. If you check in your textbook in the undergrad, your calculation method is different from how they calculated when you're doing your calculation of standard deviation in your postgrad as well. Because in undergrad, you're putting them as full percentages or full values, but when you're calculating them in your postgrad, you're going to be using what? Decimals, not percentages, when you're calculating what? Your variance in that case. So I'm going to demonstrate this to you using the information in the textbook so that you can clearly see exactly how you would get it. So remember, in this case, they say, using the example in the textbook, they give us the returns and they give us the probability of earning those returns as well. So the state of the economy is a super boom, a normal, a recession, or a severe recession. So they give us the returns and their what corresponding probabilities of those returns as well. So based on this, we are going to calculate the expected return, we're going to calculate the variance and also the standard deviation there using decimals. For expected return, you are going to use the full percentages, but when you're now calculating the variance in the standard deviations, are going to be using what? Decimals instead. So this means that when you're calculating from the example that is given, for single assets, your expected return, which is your arrow with the bar on top, is given as the sum of the return multiplied by the probability of earning that return. So this means that in this case, you're going to say is equal to the return for the first scenario, which is a super boom. Your return is 50%, and the probability of you earning that return is 10%, which is 0.1. Plus, you go on to the next scenario, your return is 30. The probability of earning that return is 0.2. The next scenario, your return is 10, and the probability of you earning that return is 45%, which is 0.45. Plus, the next scenario, your return is minus 10%, and the probability of you earning that return is 15%, which is 0.15. The next scenario, your return is minus 20, and the probability of you earning that return is 10%, which is 0.1. So given this information, it would mean to get your expected return, you're going to say is going to be 50 times 0.1, which gives us 5, plus 30 times 0.2, which gives us 6, plus 10 times 0.45, which gives us 4.5, plus minus 10 times 0.15, which gives us minus 1.5, plus minus 20 times 0.1, which gives us minus what? Minus 2. So in this case, 5 plus 6 plus 4.5 gives us 15.5 minus 3.5. It will give us a return of what? 12% return. So in this case, the 12% return is going to be our expected returns. Now, when it now comes to calculation of your risk of the single asset, we are going to be calculating the variance. So in calculating the variance, remember we said the variance is equal to the sum of the return minus expected return squared multiplied by the probability of that return. How you use to calculate do the calculations when you're doing your undergrad, even if you check in your textbook, they were using full percentages there when it comes to representing the returns. But for postgrad level, the method has changed. You are going to be using decimals, because if you use full values there, the answer is going to be slightly different. So that's why you see that for the variance in this case, it's going to be, for the first scenario, you remember your return was 50%. So as a decimal, 50% as a decimal is 0.5, minus your expected return was 12%. So 12% as a decimal is 0.12. You're going to square that, multiply by the probability of this happening, which is 10%, so it's 0.1, plus. You move on to the next scenario, your return was 30%, so it's 0.3, minus your expected return of 0.12. You're going to square that, multiply by the probability of this happening, which is 0.2, plus the next scenario, your return is 10%, so it's 0.1, minus your expected return of 0.12, squared multiplied by the probability of this happening, which is 0.45, plus the next scenario, your return is minus 10%, so it's going to be minus 0.1 minus 0.12 squared times the probability of this happening, which is 0.15 plus. On the next scenario, your return is minus 20%. So as the decimal is 0.2 minus the expected return of 0.12 squared multiplied by the probability of this happening, which is equals to 0.1. So this will give us the variance. So which means that you need to calculate the variance in decimal form of the first scenario, the second scenario, third scenario, fourth scenario, and fifth scenario as well. So if you do the calculation, how much would you get? 5 minus 9.2 times 0.1. So here you get 0.01444 plus. Zero point 0.00648 plus here you get 0.00018 plus and here you get 0.00726 plus and here you get a figure of 0.01024. So this is how much you get for each scenario. Then for your variance is going to be 0.0386. So your variance as a decimal is going to be 0.0386. Then your standard deviation is equal to the square root of the variance. So your standard deviation is equal to the square root of the variance, which means in this case, your standard deviation is going to be the square root of the variance as a decimal of 0.0386. And you get an amount of 0.1965. Then if you multiply this by 100 to make it a percentage, you get 19.65% being the variance. If you use full figures of 50% and 30% and 12% there, you are going to get an answer which is different from the ones that are going to be getting there. So please, when you're calculating, measuring the risk of a single asset, these amounts, you need to enter them as what? As decimals. Even when we're looking at calculation of the risk of what? Of a portfolio as well. These amounts, you need to enter them as decimals. Are we on the same page? Are we together then? So when you're calculating the expected return of a single asset, you can put these amounts as percent as full values or full figures there. It won't make a difference to your calculation of expected return. But when it comes to calculation of your variance there, you need to enter these amounts which are given as percentages, you need to enter them as decimals. Then when you enter them as decimals there, this will give you the variance. Then the square root of the variance, you need to leave it as a decimal there. The square root of this amount is a decimal. You are now going to multiply that by 100 to make it a full percentage there. Please take note of this. Very, very important. if you look at the way this was approached when you're doing your undergrad, it's different from the textbook that you used in the undergrad compared to the textbook in your postgrad. The reason why I remember this is mainly because when we are calculating risk from when you do market risk, which is risk management modules as well, we use decimals instead of what? Of percentages. So which means at postgrad level, you're going to be using decimals there when you're calculating the risk, whether you're calculating the variance or you're calculating the standard deviation there as well. So please take note of these slight differences there of approaches. So that's why you see that if you check in the textbook, there, your answer is your expected return is 12%. And then when it comes to measuring the risk of a single asset, they are giving you 3.86%, where the standard deviation is going to be the square root of what? 0.0386%, which gives you 19.65%, because they are now going to be saying whatever answer you're going to get, you multiply that by 100. So please take note of this slight difference there with how you treat calculation of your standard deviation at undergrad level and also at postgrad level as well. Please take note of these differences. Going to move on. Are there any questions? On the next section, we look at mean variance rule. And here they say, once the expected return and the risk have been established, a general rule becomes apparent. It is commonly referred to as the mean variance rule, and it is applicable to all investment decisions made by rational, risk-averse investors. The rule holds that the investment A will be preferred to investment B, provided that the following conditions exist. Either the mean expected return of A exceeds the investment B, and the variance are equal to for A is equal to that of B, or the mean expected return of A exceeds of that of equal to the expected return of B, and the variance of B is greater than what? That of A. So it has been given it has given rise to the technique of mean variance analysis, which is widely used way of making investment decisions. So the rule is applicable to all risk-averse investors, regardless of the degree of their risk aversion. So what the mean variance rule is shown by this diagram basically mean is that, remember we're saying that high risk, high expected return. So the mean variance rule basically says that we are seeking to maximize the return for a given level of risk, or we are seeking to minimize the risk for a given level of return. So to understand this better, we are saying when you look at the risk relationship, the risk return relationship of an investment, we're basically saying if you are given two investments, investment A and investment B, right? If you're given two investments, investment A and investment B, and then they tell you that they earn the same return, but investment A has less risk than investment B, which of the two investments are you going to choose? So your choice of the investment is going to be based on the risk-return relationship, where we are saying you, for the same amount of return, you want to choose an investment which minimizes your risk. So the mean variance rule basically says you want to minimize the risk for a given level of return. So you want to minimize your risk for a given level of return. Then let's say, for example, as well, they give you another portfolio or another asset where they say for this particular asset C, right? And asset C has the same amount of risk, but able to generate what? Higher returns. So which means in this case, your choice between investment B and investment C, when you're choosing between these two investments, you are going to choose investment C because for the same amount of risk, investment C is giving you a higher return. So which means this leads us to another rule of the mean variance group, which is basically another component of the mean variance group, which says you want to maximize return for a given level of risk. So you want to maximize return for a given level of risk. So for a given level of risk, you want to be able to maximize your return. And for a given level of return, you want to minimize your risk. Are we on the same page? So the concept of mean variance rule is basically based on that analysis. Are we on the same page? Are there any questions? Moving on. So here they say, the mean variance rule can now be applied to relevant investments. The measure of risk which will be used in this text will be the standard deviation, and it is more commonly used and more easily applied to statistical manipulation arising from normal distribution for the discussed, which is going to be discussed in the next section as well. So the mean variance rule helps us make investment decisions. So when you're making investment decisions, it basically means that for a certain level of return, you want to invest in an asset with what? The minimum risk. And also for a certain level of risk, you want to you invest in an asset with what? The highest amount of returns as well. Moving on to section 3, which looks at interpreting the summary statistics. They say the expected return is simply the weighted average of each return predicted for a given state of the economy. So the risk associated with the expected return is measured by the standard deviation of the return. So the facts provided in example 3.3 could be graphed as in figure 3.5, right? So here, figure 3.5 shows us this information to say, so what is the return and the corresponding probabilities? But this information can also be given using the normal distribution. Now, if you still remember, when you did your undergrad, you were now asked to find out exactly, now show exactly how many, when you look at your normal distribution table there, you're basically going to be saying how many of, at 68.3%, what is going to be the values, or what values are you going to be, what range of values are you expected to calculate, to analyze. When you're considering 95.5% of your values, what is going to be the range of returns that you're expecting to analyze there? At 99.7% range, what is the expected range of what values are you looking at, what analyzing there as well? Please take note, when it comes to this distribution, you didn't cover it at undergrad level, and the lecturer is not expecting you to know this distribution to say, so what amount or what range of returns are you expecting to analyze when you're looking at what the number of standard deviation around the mean? This, leave it out, is not relevant to you. So when you look at your continuous probability distribution now, which shows you the normal distribution to say 68.3% of your values are going to be found within within the mean. 95.5% of your values are going to be found within a number of standard deviation around the mean. and 99.7% of your values are going to be found a number of standard deviation around the mean as well. Don't worry about this. It was not covered when you're doing your undergrad, and it's not expected to be covered now. Now, we are now going to go further and look at comparison of single assets. So we are going to look at comparison of single assets. And when you look at comparison of single assets, they say we are focused on the summary statistics relating to the single investment opportunity. When faced with alternative investment opportunities, the investor who wishes to make the choice between two single investment opportunities needs some rationale in which to base their decision process. So here, the rationale is, please take note of this. When securities have the same expected return, so when securities that are comparing have the same expected return, the relevant measure of this is equal to standard deviation. So whenever securities have the same expected return, the relevant measure of risk is your standard deviation. But whenever you find securities with what? Different expected returns. So whenever you observe securities with different expected returns, note that your relevant measure of this is your coefficient of variation. So when you're observing and having a choice between securities with the same expected return, the relevant measure of risk is your standard deviation. So you just calculate the standard deviation of the security and the standard deviation of the other security there. When you're comparing the standard deviations there, then it basically means that whatever you're observing there, whatever the standard deviation that you're going to be choosing there is going to, the observing there is going to determine your choice of investment. So in this case, you choose security with lower standard deviation, considering that you are what? A rational investor who's not seeking to take on risk. But whenever you are looking at security, comparing security with different expected return, your relevant measure of risk is going to be the coefficient of variation. So in this case, ideally, you choose security with lower coefficient of variation. So please take note of this. So now the question is, how do we determine the coefficient of variation? Your coefficient of variation is given as your standard deviation divided by the expected return. So your standard deviation divided by the expected return gives you the coefficient of variation. So your coefficient of variation is given as your standard deviation divided by the expected return. So it means if you observe the information that is given on the question, they give us an example here where you are choosing between Trinpack and Clayco investments. The returns are 22 and 22%, and your standard deviation is 9.2 and 15.4%. So in this case, past performance may be used as surrogate for expected future returns. So given the expected return are identical for both investment alternatives, on what basis is a choice between the two investments? So the two alternatives are presented in a rough graph on figure 3.7. So if you look at this, what do we see? Based on this investment, or based on this, we see that our choice in this case is saying, with investors showing preference for Trinpack on the basis of facts outlined, what is the likely result? So the greater demand of Trinpack is likely to force the price upwards, and conversely, the lesser demand for Clayco would place the price downwards on its price until the equilibrium point where return commensurate with the risk establish what? The market price. So which means in this case, what does that mean? We're basically saying that if you're going to be comparing these two investment portfolios, your choice is going to be based on their standard deviation. So which means in this case, you're going to choose TrinePack because it's got a lower standard deviation. Because they have this what? Similar or same expected returns. Then you're selecting between two alternatives with different expected returns. So when you're comparing investments with two different expected returns, where they're giving you examples of Atlas Limited and Brenco Limited. Their expected returns are different. Their standard deviations are also different as well. So what do we see? Your choice of the investment is, if you just consider the standard deviation, you will see that you would choose Brenco because Brenco has a lower standard deviation than what? Than Atlas. But is this reliable? They basically say you have to look at what? Calculation of the coefficient of variation. And when you look at the calculation of the coefficient of variation there, you see that the coefficient of variation of Atlas is 0.5, and the coefficient of variation of Brenco is going to be 0.4. So which means that the results indicate that Atlas exposes the investor to 0.5 units of risk for each unit of expected return, while Brenco exposes the investor to 0.4 units of risk for every unit of what? Of return. So on relative basis, therefore, Brenco seems to offer a better trade-off between expected return and risk. So which means whenever, as a rule of thumb, your coefficient of variation basically says how much risk are you exposed to as an investor per unit of expected return. So which basically means that if that is the case, whenever you see securities with different expected returns, your relevant measure of risk will be the coefficient of variation. So which means your choice of investment there is the choice of investment will be the investment with what? With a lower coefficient of variation as well. Because you're saying this investment gives you a lower risk per unit of what? Expected return. So please take note of this as a rule of thumb. Are there any questions when it comes to the use of the standard deviation and the use of the coefficient of variation? Any questions? Now, moving on, when you're doing your undergrad, in your previous textbook, they also gave you the issue of the Z-score as a measure of risk and making choices between two investments. But now when you're doing your undergrad, you didn't cover the concept of Z-score. Yes, when we do market risk, if there's other people who do market risk at postgrad level, yes, we do cover the Z-score. When you look at what is that? When you look at credit risk and market risk as well. But for Fin4801, the Z-score was not a concept covered. Yes, it was in the previous textbook for Fin2601 and Fin3701, but it was not necessarily covered in those textbooks, in that curriculum as well. They leave it out completely. So which means for postgrad level, you're not going to be worrying about the concept of what? The Z-score. So the concept of the Z-score in this case, don't worry about it. Mainly because analyzing the Z-score, you're going to be going back and referring to your Excel spreadsheet and analyzing to see exactly what the value of the Z-score would be equal to as well. So because of this, you're not going to be worrying about the calculation of the Z-score when it comes to Fin4801. So the concept of Z-score, leave it out completely. It's not relevant to you. The next assessment that we're going to be looking at is the concept of covariance and correlation and how they relate to each other as well. So here they say the covariance measures how share returns move together and specifies the strength of the relationship between the share return movements. So it indicates the extent that the share returns co-vary, right? So for Fin4801, you are not going to worry about calculation of the covariance, like using this formula. You don't have to worry about that calculation. They will never ask you a question based on calculating the covariance using this formula. What you need to worry about is this formula here. I'll discuss it with you just now. So here they say when your covariance is basically greater than 0, it means X and Y will tend to move in the same direction. And when your covariance is greater than 0, it means x and y is less than 0. When your covariance is less than 0, it means the return of x and y move in what? Opposite directions. And when your covariance is 0, it means that the return of x and y are generally independent of each other. Then we now look at the concept of correlation, where we say your correlation is given as the covariance of x and y divided by the standard deviation of x and standard deviation of y. So which means for Fin4801, what you need to take note of is this formula for determining the correlation coefficient between the two assets. It's relevant now. You see that in chapter 4, it's also going to be coming in relevant as well. So the correlation coefficient is given as of asset x and y is given as the covariance of asset x and y divided by the standard deviation of asset x multiplied by the standard deviation of asset y. So this gives us the correlation coefficient between the two securities. So for Fin4801, know that if they give you the covariance and the standard deviations, you should be able to calculate and determining the correlation coefficient. Calculation of the covariance given the list of returns of x and y, don't worry about it. They will never ask you that. Then what you need to worry more about here is the interpretation of the correlation coefficient. So your correlation coefficient is always going to be found between between -1 and +1. So your correlation coefficient is always going to be found between -1 and +1. When it's at +1, this means that at here, it means the correlation between the securities are basically, when you look at the return between the market and the security, we're basically saying that if, let's say, for example, let's say you have securities X and Y, security Y here and security X. We're looking at the return over time. We're looking at the return over time. So when you're looking at the interpretation of the correlation coefficient being equal to +1 there, we're basically saying if security M, the return of the security M are moving in this particular direction, we're also saying that security N would be having something like this, where we're saying that if security N goes up, the return of security N goes up, security M is expected to go up. If the return of security N goes down, the return of security M goes down as well. So they're basically moving in the same direction. If they're moving exactly in the same direction, we are saying that the correlation coefficient is what? Is at +1. And this is where we say it's perfectly positively correlated. So we say the securities are perfectly positively correlated because they are moving exactly in line with each other. When one goes up, the other one goes up. When one goes down, the other one goes down. Then when the securities are having a positive correlation, but not necessarily moving exactly in the same direction, we say they are just generally positively correlated. Then when the two sets of securities are not necessarily moving in the same direction, like for example, if you look at the return of asset M and N as well, let's say N is something like this, the return over time, it means if they are perfect, if they are going to be having a correlation coefficient of -1, it means when one goes up, the other one is going down. So it's something like this. So when N is going up, N is going down. And when N goes down, M is going up. So they're basically moving in opposite directions there. So this is where we say their correlation coefficient is what? Perfectly negatively correlated. And if it's somewhere between -1 and 0, we just say they are just generally negatively correlated. Then if there's no particular direction or no particular relationship between the return of X and return of Y, if there's no particular relationship between those returns, that's when there is going to be having a correlation of what? Of 0. And if they're having a correlation of 0, this is when we say the secret is a what? No linear correlation. So there's no linear correlation. So which means their returns are basically moving with no particular patterns or relationship there. So that's basically what you need to know when it comes to correlation coefficient. So that's basically what you need to know when it comes to the interpretation of the correlation coefficient. Are we on the same page? Now, please take note as well. Do you see that now as a potential mathematical manipulation? Remember here, they say the correlation of X and Y is given as the covariance of X and Y divided by the standard deviation of X divided by the standard deviation of Y. If you do the mathematical manipulation there, do you see that if in case they ask you to calculate the covariance, you can also say the covariance of X and Y, 1 times this gives you the covariance of X and Y, is equal to, if you multiply these two, it means is equal to the correlation coefficient of X and Y multiplied by the standard deviation of X multiplied by the standard deviation of Y. Because if you do the cross multiplication here, it means potentially as a short question, they can ask you to say, determine the covariance between asset X and Y. And this is how you'd be able to calculate the covariance given the correlation coefficient and their standard deviations. So this is potentially how they can ask you to manipulate and calculate what? The covariance. The other formula there, where you're given the returns of asset X and the returns of asset Y, don't worry about it. I've never seen the lecturer asking you regarding that. Are we on the same page? Are there any questions? Moving on, please, this concept of correlation coefficient, please take note of it. It's going to come in very relevant as well in chapter 4. We're going to go back to it again in chapter 4 when we're now analyzing what the risk-return relationship of a portfolio as well. Please take note of it because I'm going to come back to this again. But I'm not going to look at this in detail in analyzing this before we look at what the chapter 4 as well. So we're going to come back to this concept again, chapter 4. Then, moving on, they give us an example, don't worry about it. The concept of value at risk. Yes, when we do cover it with my students in market risk, we do cover it. But here, value at risk is also used as a measure of risk as well to assess different investments. But for Fin4801, don't worry about it. You are never going to be asked calculation of what? Value at risk. So leave it out completely. Expected shortfall, leave it out completely because it's also related to the calculation of value at risk as well. So expected shortfall calculation there, leave it out completely. They also look at risk and return in financial markets, where they ask you, where they are analyzing the risk and return in different markets around the world as well. So this is basically from a practical perspective and not necessarily, but remember in your exam, the lecturer gives you a case study, and based on that case study, you analyze the information based on that case study. So this is historical analysis of the risk return in the different financial markets around the world as well. Yes, for practical purposes, you need to know it, but for the sake of the exam, don't worry much about it. It's not something that you'd expect what to be examinable when it comes to the exam. So don't worry much about this relationship or the information analyzed there. Then they also look at the risk-return relationship in emerging markets as well. Remember, these are sections which are covered to say, from a practical perspective in practice, this is how you're analyzing the risk-return relationship. But remember, for the sake of the exam, analyzing the risk-return relationship for specifically say in emerging markets, what are the risk-return relationships there, don't worry much about it. So don't worry about it. Where they talk about the Rip Van Winkle solution to risk, don't worry about it. It's not something that I would say the lecturer would ask you. What does Warren Buffett think? Yes, for practical perspective, you need to know it, but for the sake of the exam, don't worry much about it. Now, on the next section, potentially the lecturer can ask you as short questions when it comes to analyzing the risk-adjusted measures of performance. So the lecturer can potentially ask you to analyze the risk-adjusted measures of what? Of performance as well. So when you look at the risk-adjusted measures of performance, there are different methods which are used. So here they say, in table 3.1, equities offer higher returns, but also higher volatility than bonds and bills. So however, the question is whether returns are enough to offset additional risk of equities. So further, it is useful to compare portfolios of unit trusts on the basis of risk-adjusted returns. So we have already explained the coefficient of variation, which is equal to the investment standard deviation divided by the mean return. We will now explain few other risk-adjusted measures often used to by fund managers to evaluate performance related to risk as well. So these measures are, the first one is the trainer ratio. So with the trainer ratio, we're basically saying, so the trainer ratio sometimes they refer to it as the trainer performance index. The trainer performance index. Sometimes they refer to it as the trainer performance index. So the trainer ratio is given as the return of the portfolio minus the risk-free rate of return divided by beta of the portfolio. So the return of the portfolio minus risk rate of return divided by the beta of the portfolio gives you the trainer ratio of that particular portfolio. Then the other measure of risk is the Sharpe ratio. And your Sharpe ratio is given as, sometimes they refer to it as the Sharpe performance index. So the Sharpe ratio, sometimes they refer to it as your Sharpe performance index. And your Sharpe ratio is given as the return of the portfolio minus risk rate of return divided by the standard deviation of the portfolio. So do you see where the trainer ratio differs from the Sharpe ratio? The numerator is the same, but where they differ there is the measure of risk that is used in assessing the performance. Here, we assume that the relevant measure of risk is beta, and here, the relevant measure of risk would be the standard deviation of the portfolio. Next, there is also the Sortino ratio. And with the Sortino ratio is equals to the return of the portfolio minus the minimum acceptable return. So the investor will know exactly what the minimum acceptable return should be, divided by the downside deviation. So the downside deviation there is the standard deviation where the portfolio has failed to meet what? The minimum acceptable return. So where the portfolio fails to meet the minimum accepted return, the standard deviation of those returns is basically what we refer to as the what? Downside deviation. Then there is also the Jensen's alpha. And the Jensen's alpha, sometimes they put it as an alpha like this. It's given as return of the portfolio minus your risk rate of return plus beta in brackets market return minus risk-free rate of return. And this gives us the Jensen's alpha. So if you look at the Jensen's alpha, do you see that this part of the equation is basically your required return based on the what? Capital asset pricing model. It's your required return based on the capital asset pricing model. And remember, when you look at this as well, your market return minus risk of return gives you the market risk premium. So please take note of this. Your market return minus risk of return gives you the market risk premium. In most cases, the lecturer loves to give you the market risk premium instead of giving you the market return as well. So if they give you the market risk premium, it means this part of the equation has been done for you. You multiply by the beta, then you add the risk rate of return. This gives you the required rate of return. Then you say the return of the portfolio minus the required rate of return gives you the Jensen's alpha. So looking at all these performance measures, the idea is that your choice of portfolio is going to be based on the one that is giving you the highest risk return per unit of the highest return given the risk as well. Please take note as well. Whenever the trainer, the Sharpe ratio, and the Jensen's ratio clash, your choice is going to be based on the Sharpe ratio. So whenever the trainer ratio, the Sharpe ratio, and the Jensen's alpha, whenever they clash, maybe the Sharpe ratio gives you a certain conclusion, the trainer and the Jensen ratio gives you a different or opposing conclusion as well. You choose the Sharpe ratio. Why? Because these two, they assume that the securities are what? Fully diversified. And it's not all the time that the securities are fully diversified. If the securities are not fully diversified, it means the relevant measure of risk would be the standard deviation. Hence, you choose the Sharpe ratio. Are we on the same page? So please make sure that you take note of this. Very, very important. After this section, we look at the Jensen. After this section, they give us that example of the unit trust investments. Don't worry much about it. What returns did Warren Buffett achieve with Berkshire Hathaway? Yes, for a practical perspective in the real world, yes, you need to know that. But from for the sake of the exam, we're not going to worry much about it. And the performance of Berkshire Hathaway from 1965 to 2017 as well. Yes, from a practical perspective, you need to know it for interest sake, but for the sake of the exam, you don't have to worry much about it. So do you see that there are certain sections that we are leaving out because they're not necessarily covered when you're doing your undergrad? So they're not deemed to be relevant. And there are certain sections where they give you information from a practical perspective, but we know that for the sake of the exam, the lecturer will always give you the case study, and based on the case study, expect you to answer the questions. That's why we left out those sections. And please take note of high importance when you're calculating your standard deviation, your variance in your standard deviation, whenever you're calculating your variance in your standard deviation for postgrad level, always put your returns as decimals, because if you, for interest sake, the example that was given in the textbook there, if you put those values as if you put those returns as full values, not as decimals, check to see exactly how much you get as your standard deviation and your variance there. You see that your values are going to be very different. So it's very, very important. And if you compare that with how it was approached at undergrad level, there's a bit of a disjoint there. So please take note of that as well. Very, very important. Are there any questions? All right, if there are no questions, enjoy the rest of your weekend. Remember, assignment 1, we've done it already. So we're going to be concentrating on the next chapter and see exactly when they're going to be releasing assignment 2 so that we also attempt it as well. All right, enjoy your weekend.